Okay, we're now going to look at the disparity index. We've looked at Western ways of measuring overbought, oversold. We looked at Bollinger Bands. We looked at oscillators. Okay? And now we're going to be looking at the disparity index. And essentially, the reason I wanted to discuss the dual moving averages for a few seconds in the prior slide, is because this is a little similar to that. But the disparity index is, it compares two moving averages, but what's unique about it is that it compares, as a percentage, the close of the session compared to a moving average. So it means is when, and I'll use an expression here or one of the things, the Japanese say that the 13-week disparity index, a lot of them will look at weekly charts, but the 13-week disparity index is minus 25%. It means that the close this week, if you're looking at a weekly chart, is 25% under the 13-week moving average. All right. So if we have a disparity index of plus 12% above, let's see, 12% above its 12-period disparity index, that means it's 12% above its 12-day moving average. I use for the disparity index, okay, as I mentioned here, it's a way to gauge overbought, oversold, and it compares the current close to a moving average. Now, I use, for reasons beyond the scope of this seminar, I use a 12-day moving average for my disparity index. And so it's not between 0 and 100. So if you have if you have here, for example, down here, the disparity index is 94. What that means on the close of this doji session, the market is 6% under its disparity. So here, and it depends on how they get plotted. They may have it as minus 6%. Okay, I had them do it as 94%. So that means this is at 94%. It's 6% under its 12-day moving average. And the numbers really aren't that important. What you do is you look at, like you would with the dual moving average, you look at historically, I would normally go back further than this. Historically, when the market was oversold, it could have been here, it could have been down here. So historically, this is an oversold indicator in Google, at least at that time. So the market was oversold here based on the disparity index. We had a doji confirming an oversold market. Here, we had a hammer, but based on the disparity index, knowing that this is oversold territory and up here is actually overbought. Based on the fact this is oversold territory in this stock, we have a hammer. Is the market oversold? No. Doji here, is the market getting a little bit more oversold? Not as extensively as down here, but with a little bit more oversold, right? And I don't think many of you use this. Many of you will be using oscillators, but I thought it was kind of interesting to talk about in case you wanted to fool around with it. Because this is really good for short term because you're comparing today's close to a short-term moving average. And so you're getting a really fast, reactive way of gauging if the market's overbought, oversold. With the other indicators, the oscillators, the RSI stochastics, you're looking at a moving average, 14 days, 9 days. Here it's the close compared to a certain moving average. So it's a lot more susceptible, vulnerable to short-term short-term movements. And something to keep in mind is that the blue lines, this market is overbought based on the disparity index. And it doesn't matter whether it's disparity. If you have an overbought market, however you gauge it, the market's overbought. By trading sideways, look what's happening to the overbought condition. It's being relieved. The market gets overextended here. Once again, I'm using disparity, but you can use whatever measurement you want to. It's getting overextended. By trading sideways, what's happening? It's relieving the overbought condition. And this is why stops are so important. Because we know if we have a doji or a spinning top, the trend has gone from up to neutral, correct? And one would think mistakenly that the more doji you have or the more spinning tops you have, the more likely reversal. You're extending a resistance line, which makes, I think, a trade from the short side better because you have a tight stop. But you're also, in a plus side, you're also relieving an overbought condition. And what that means, if the market breaks out, expect it could be a potentially big move. All right? So for those who would rather go on strength, buy momentum, wait for break above the resistance area, because by trading sideways, the market is not overextended on the upside anymore. Same thing here. Look at this. The market overbought, digesting the gains, and then once it moves out, boom. And the same with the downside. If the market's oversold, whatever index you use or oscillator you use, oversold. If the market trades sideways and building a base, it could look potentially positive. You have hammers, you have doji. And again, doji I like better at calling tops, but if you have a doji confirming a support area, I'd still watch it. But you're going from an oversold market to a neutral market. And while it does increase the likelihood of the market turning, there's no guarantees. If the market breaks the support, it could really get going on the downside because you're not oversold now. The market's not oversold. Make sense?
Yes.
Okay. Now we're going to be looking at record sessions. Record sessions is another way the Japanese gauge overbought, oversold. And essentially what the record sessions does is if the market makes a new low for the move, you don't know that until after the market starts moving up. Once it makes a new low, you start counting the number of higher sessions. And these are these are obviously not candle lines, just these are the highs and lows of the session. Every session, whether it's an intraday or daily or weekly, and I haven't looked at this intraday, I looked mainly at daily and weekly. Every day it makes a higher high, it becomes record session 1, record session 2, and so forth. And you can see, can you see why between record session 2 and record session 3 it's not numbered? Right. It didn't make a higher high. And the Japanese will say, and this is based on the Nikkei, okay, that if you have anywhere from 8 to 10 record session highs, the market is vulnerable to a correction. Nothing magic about that. I've seen markets go 15, 20 record session highs. What I would suggest is looking at your market, and like I said yesterday, the personality of a market is like a person's face, never two alike. Look at your market, see how many higher highs it had before it really started to correct. I would never, ever sell. I would never initiate a new trade just because you have record sessions. If you have record sessions and then you get a bearish candlestick signal, I would still use that to exit a position unless you're confirming a resistance area. But this is a good way to gauge if the market is overbought, another way to gauge if the market's overbought or oversold. In fact, if you have let's say 8 record session highs, the Japanese would say the stomach is 80% full. Okay, so here, the market made a new low for the move, and you start counting higher highs. And here you have record session highs. And I hope I did the count right, but you can see between 6 and 7, it's not a record session high. All right. Same thing between 7 and 8. And once again, your market could be 15. It could be 8. And here we had a bearish engulfing pattern. So even though we had record session highs, the market's overextended, this bearish engulfing pattern I probably would sell short because you have a clean cut resistance area. See the market's rolling over, you have small real bodies. But normally I would suggest using it just to exit a position. Same thing here. And this one looks good because it's confirming a support area. You have a hammer, and actually 8 is a hammer is one of those dragonfly doji. Okay. Same thing here. Okay, and you can look through this when you get back. But once again, I would suggest looking at your markets. One thing I do want to bring out, though, over here, record sessions in red, 1 through 10. Hopefully I did the numbers right. Dark cloud cover. Now, look what's happening here in the blue. Record sessions 1, 2, and 3. So the market made a high here and then makes lower lows. And I should have mentioned, obviously, there's record session lows also. Every time you make a lower low, and let me go back here. Sorry about that. So here, record session lows is you have a high for the move, and you don't know that until the market starts moving down. So this is low 1, this is low 2, low 3, low 4, and so forth. So here we have record session lows in blue on the right, 1, 2, and 3. The thing with the record sessions, because it's gauging overbought and oversold, and let's kind of merge what we talked about as a way to relieve overbought oversold. If the market is, in this case, moving down from record session 10 and starts moving down, if the market's moving down, how can we relieve the oversold condition? Sideways, exactly. There's two ways to relieve overbought, oversold: by price and by time. What that means, if the market has a tremendous rally, say it goes from $30 to $50, the next day it drops to $40, that's relieving the overbought condition by price. If the market goes from 30 to 50 and hovers around $50 for a week, do you think the market's getting comfortable with that price level? Sure. Okay, so with that latter scenario, what we're looking at is as far if the market makes a big correction. So here, with candle lines 1, 2, and 3 in blue, if the market had a sharp rally, which it didn't in this case, but if it had a sharp rally, you start the record count all over again. Or if it trades sideways, as it did here, and the number I would use is 5. If it trades laterally for 5 sessions, start the count all over again. If you want to be a little bit more conservative, do 4 sessions. So here, by the market treading water, we have to start the count all over again. So we now have a higher high over here, and we have to start the count all over again. And with these 4 sessions, I probably would start it again because the market traded sideways. Because the record sessions, you want the market overheated either on the upside or the downside. If the market's trading sideways for 4 or 5 sessions, it's self-correcting. Retracements. Okay, and retracements, common retracement, 50%, but I'm sure some of you use Fibonacci retracements, especially in the Forex market. So we'll be spending a couple of minutes on retracements. Again, I would never place a candle signal. I'd never place a trade on a retracement. Use it, and if you get confirmation with the candle, then you can become a little bit more aggressive. So here, common retracement, 50%. I'll put these down, Fibonacci retracements. 50% happens to be a Fibonacci retracement also. So the market goes from $100 to $200. These are retracement levels, 38.2%, Fibonacci 50%, and 61.8%. Fibonacci more popular from what I hear in the Forex market than equities, but a lot of traders will use these in equities as well. But 50% is very common. Okay, a lot of traders, even if they don't use the other Fibonacci's, 38.2% or 61.8%, will use 50%. So here, for example, are some retracements. So on the left here, okay, we had a sell-off, and these are just Fibonacci retracements from the software. And so right around the 62% correction, 50%, 62% is what I look at, 60% correction, you have these reversal signals. We wouldn't go short here, though. Why? The window, yeah. So maybe it's an area to take some profits. Okay. And this is better when the market really moves briskly, because a lot of times, for example, here with a sell-off like this, it's kind of hard to get a resistance area. If I don't see anything intraday, that's when I use retracements, when it's a big move either up or down. Same thing here. Look at this. Okay, big move on the downside. No clear-cut resistance areas. A little gap down here. I'd look at resistance, and I think I don't know if we got above it or it was pretty close. So here we have, again, a brisk sell-off, assuming there's nothing on the intraday that gives us hidden support or resistance. Okay, we'd use some retracements here. Same thing here. Now we're going to look at moving averages. Okay. And just wanted to show you, this is a page from one of the books that I had translated, and so you can see, this moving average here. I don't know what to use, but you can see tall white candles confirming the moving average over here. We'll look at patterns later, but we can see this combination, little shaking hands, east plus west, and that's what we're going to look at now. We're going to look at moving averages. And lots of types of moving averages. We're not going to go through all of them. The simple, the weighted, the exponential. I talked about the exponential a couple of minutes ago, and dual and triple moving averages. And simple moving average is very basic. You just add X number of days or sessions, whether it's intraday or not. Usually the close, you could use a moving average of anything, and you take those number of periods, let's say 20 days, and you add up all the prices, and you divide by the number of days in the moving average, say 20, and you get a moving average. So here, moving average, the oscillators are more effective in lateral markets. Moving averages are better in trending markets. But like an oscillator, a moving average is a lagging indicator. So here is a neutral, lateral market. You can visually see it, and moving averages are really not that effective in it. A couple of ways of using moving averages. One, as a trend indicator. So some people will say if the price of a stock is above a 200-day moving average or whatever moving average they like using, the trend is up. You'd use it as potentially support or resistance also. So here, for example, is a moving average. And I don't have a favorite moving average. What we do for our clients is I ask them what indicators they look at, and I add them to my charts. So a lot of the traders will like 30 and 50-day moving averages. Probably the more popular ones are 10, 30, and 50-day. But I would keep an eye on the 200-day moving average because although it's a long-term moving average, and even if you're a short-term trader, a lot of people look at the 200-day moving average. So if a lot of people are looking at it, you should be looking at it also, although, it's not something we're going to be trading with every day. But so here we have moving average as resistance. The challenge with using moving average as support or resistance, what works well then may not work again now. So you may find markets work particularly well. So you see something like this, where you have a bullish engulfing pattern confirming a moving average, and you can see how nicely it worked over here. So you pay attention to it. Now, this was a market that I was following for one of our clients. He or they were following Fannie Mae bond prices. These were mortgage-backed securities. And this was a while ago. This was back in 2002. This was years ago. But what was interesting about this is they found, see, like I said, they tell me what their moving averages I should use when I do the analysis for them. Look at the 25-day moving average. They said that works well in their market. There's no way I would know that. It's based on their experience. So the market closed into the 25-day moving average because they were using it as support. And obviously their candle lines are green and red instead of white and black. But the first indication of a turn, potential turn, came with that gravestone doji. So it's a potential early reversal, but the confirmation came on the close under the 25-day moving average, because that's the moving average they found that worked well. And indeed, looking at this, you can see it does. Now, this is something to pay attention to here, because you could have a group of signals, like, for example, here's a hammer. But if you have a moving average, and I forgot which one I was looking at the time here, but if you have a moving average like this, where it's acting as a strong upside barrier, although you have a bullish candlestick signal, I would want to see a close above that moving average. So here we have a hammer, but the moving average was still acting as resistance. A few sessions later, market was bottoming out, another bullish candlestick signal, the bullish engulfing pattern. But can you see what the difference is now? It closed above the moving average. So we have two potential bottom reversal signals, but one of them closed above resistance. The same concept as a resistance line, right? You could have a bullish candlestick signal, but if it's at resistance, you don't do the trade. Same thing here. This moving average is acting as a barrier. We're going to go through now candles and price patterns. And once again, there's lots of price patterns, and some of them I'm not going to be touching on, but to show you ways of combining candles and price patterns. A very popular one is head and shoulders. And head and shoulders is when the market rallies. Head and shoulders top. The market rallies. The second rally, there's three rallies. The second rally is higher than the first and the third. This is called the left shoulder of the head and the right shoulder. And when you connect the low of the head, it's called the neckline. And then you could use change of polarity. When the neckline is broken, and this could be at an angle, by the way, for those familiar with this pattern. The neckline is broken, that prior support area becomes potential resistance. This is an inverted Head and Shoulders. And for those of you who have read my books or other educational material, you know in Japan they call this a 3 Buddha pattern. And I actually got a picture here in a Buddhist temple. This is a real Buddhist temple. The internet is great. You go to Google, you put in Buddhist, and you look. You go through all the graphics. So the power of the internet is just amazing. It really floored me. Years ago, when I was on for my marketing person, we were trying to set up a phone conference, and we just couldn't arrange it. I remember looking at a cartoon in New Yorker magazine, and there's a guy in a business suit. He's behind the desk, and he's on the phone, and he says, "How about never? Is never good for you?" And I thought that'd be a great cartoon to send to him. So I go to Google, "Is never good for you - New Yorker cartoon." It's there. It's just amazing. My son, on his cell phone, he has something through Verizon. You could play music anywhere, through a speaker, through a radio. You put the cell phone by the music, and listen to music for a few seconds. It gives you the name of the song. It's just amazing. My son's in Ithaca, and the washing machines and dryers, when they're done, he gets an email. It's just... It's a great idea, so you don't have to hang out at the washing machine and dryers. He gets an IM and an email, your wash is done. Isn't that amazing? Who knows what's going to be years from now? So anyway, here's a 3 Buddha, and the main Buddha, the main saint, is in the middle, and there's 2 smaller Buddhas, so this is how the Japanese got their name. So here's the Head and Shoulders top, and you can see the angled neckline becomes resistance. By the way, one of the nice things about the Head and Shoulders, and one of the reasons we're talking about Western Technicals is because you get price targets with Western Technicals. So you go from the high of the head to the neckline, and I actually showed it in the prior slide. Let me go back here. Okay, you can see from the high of the the high of the head to the neckline, and you take that distance from wherever the market broke out, and you have a potential target. Now, be careful with targets, because a target doesn't equal support or resistance. It's just a minimum objective. If you get a candlestick signal confirming a target, I would use that to take some profits. And we're going to look at examples of targets when we talk about trade management a little bit later, and you'll see why. Okay, Head and Shoulders here. And because a lot of the price patterns take time to evolve, what you're going to find is many times you're going to get reversal signals with the candles before the price pattern is confirmed. But if you want that extra confirmation, if you want to add it to a position, then you can do that after the price pattern is after the price pattern is confirmed. So here, for example, a group of signals here. A bearish Harami, a shooting star, even if it wasn't, I'm not sure about the lower shadow, might be too long, but a bearish Harami, a bearish engulfing pattern, and see the confirmation of the Head and Shoulders came on the close under the neckline, has to close under the neckline. So we've got early indication. You're going to find this, again, like we saw with the oscillators, a lot of times you get earlier indications of reversals with the candles, and then you get final confirmation. It takes a little longer time, but with the oscillators, same thing with a lot of these patterns. Here, what was the low on this there's a 5-minute chart. Okay, it doesn't matter though. What was the low? The market made an inverted Head and Shoulders. The neckline became a resistance area, but what was the low? What kind of signal? We actually got a group of signals. A hammer, right? A hammer, a bullish, a piercing pattern, a bullish engulfing pattern. So, and this is what you see frequently. Okay, Head and Shoulders again. So we get the Head and Shoulders neckline. The confirmation has to be close under the neckline over there. But just as we saw a group of bottom reversal signals with the candles, on the prior slide, here we have a group of reversal signals, bearish engulfing pattern. Actually, if you look at the candle line before the box, this is an evening star. Everybody see it? Yeah. All right. And then actually another evening star over here. Okay. And here's a bearish engulfing pattern confirming resistance. It didn't work out. See, sometimes you can have east confirming a resistance area, and it's not always going to work. Okay, candle shout sell here. Okay, and that's the price target. Okay, here's an inverted Head and Shoulders. That was confirmed at 132.90. There's a Forex market. And what we're going to do now is we're going to zoom in this yellow circled area. See what the candles highlighted. So while the inverted head and shoulders close above the neckline of the inverted head and shoulders occurred at 132.90. Okay. Morning star, bullish engulfing pattern. So we had a group of signals at much lower levels. It looks like around 129.20. It's a little hard to see over here. Once again, if you're a little bit more concerned, so that's an extra 300 pips. Okay, if you trade Forex, you know that's a lot of money in your pocket. Now, if you were a little bit more conservative, you know what we would see is, although we had a bunch of bottoming signals here, if you're looking at an intraday chart, see? Resistance. So although we were getting potential bottoming signals here, I'm sorry, this is a daily chart. Although we were getting potential bottom reversal signals on the daily charts, those who want a little bit more odds on your side would wait for a break above this resistance area, which occurred here. So, but he's still looking at hundreds of pips. And then, interestingly, this resistance became what? Right. But the point is, the reversal signal with the inverse head and shoulders, you got at 132.90. And just to give you a sense of where that is on this chart, that's up over here. Wow is right. Yeah. And whether it's Forex or equities, this is going to occur with great frequency. Those early reversals ahead of traditional longer-term Western technicals. Okay, safety first trading. So here we had a head and shoulders. We got a price target here. Okay, bottom, a few reversal signals. Now the market's moving up. However, we now have the old support, the head and shoulders neckline. This is very traditional. Becoming a resistance area. So right at the resistance area, we have a bearish engulfing pattern. So if you were thinking of going long, even on this rally, certainly, first of all, we have although we have a white candle here, we're getting near resistance, and this is confirmation that that old support becoming resistance is holding. So we certainly should not be thinking about buying over there. Okay. And this is why we need Western technicals. Candles, the Western technicals give us price targets. Okay, so you go from the bottom of the neck, from the neckline to the bottom of the head, and you take that distance to the breakout point, and that gives you a target. And if I got a bearish reversal signal here, I don't know if this was quite a bear hat on me, because it's not 20. I don't think it's 25%. But if you got a reversal signal here, this is certainly confirmation to. If you're long and you stay long, you know, if you have any reversal signals on the way up to your target, you'd certainly take profits. Or at least some profits. Now, box range breakout is pretty cool because the box range is a lateral trading environment, and the way I like to compare it's like a coiled spring. You're compressing the spring, and a lot of times you just don't know which way the market's going to break out. We talked about potential ways of trying to forecast a breakout by looking at the number of black and white candles, the shadows, looking at the if we make lower highs and things like that. But it's normally very difficult to predict which way it's going to break out. But whichever way it breaks out, you could take the height of the range and add it to the breakout, whichever direction it's going to be in. So if the market breaks out on the downside, first of all, if it breaks the bottom end on the left, on the bottom end of the box range, what should become resistance? The old support level, right? So if the market breaks the bottom end of the box range and you sell with the target down to here, so the market breaks here, what price says you're wrong? If it gets back above there. Box range here, and for box range, it has to be resistance tested at least 2 times and support tested at least twice. So a box range breakout on the left to the downside, and a box range breakout to the right on the upside. Okay, here's a box range, and this one was interesting. Market got to the target, and look what we got at the target. Bearish engulfing pattern. Now, this to me is not really aggressive enough with the east-west confirmation. This is not the same as confirming resistance. This is a measuring target. So if you are going to initiate a new trade, realize it's a higher risk trade than it would be if the market was confirming resistance. I certainly would take profits there. If you were long, exiting is fine. But if you're going to initiate a new trade, I would recommend against that unless you're much more aggressive, just because the market got to a target and you get a candlestick signal. That is not the same as confirming resistance. Okay, everybody see that? Make sense? And became support. Okay, bullish engulfing pattern. Okay, here in crude. Okay, an evening star. Okay, this is actually a falling off the roof, but the falling off the roof over here was this here, and your stop on falling off the roof is what? Or let's even forget about the falling off the roof. The stop on the evening star is the high of the evening star, right? So as soon as the market got above that, you're wrong. Right. So the market broke out top end of a box range. It came back down, but then it got it back above it again. Okay, so we take that measurement and we get a target there. And there we get a series of small real bodies, high wave candles. I don't know if it's quite bearish engulfing patterns, but high wave candles and doji. And the market corrected from there. Okay, triangles, ascending and descending triangles. An ascending triangle, and it's kind of interesting because the shape of the pattern kind of implies which way it's going to break out. So an ascending triangle, horizontal resistance, and what's happening with the lows, you have higher lows. So what's happening is buyers are getting more aggressive. They're buying at higher levels. And once the market breaks above the resistance area, it's a bullish breakout. You could take the height of the triangle from when it started, and once again, it should be tested at least twice as resistance and twice as support, and add that distance to the breakout point. And a descending triangle is the opposite. And you get to see change of polarity again. Horizontal support tested a few times by the blue lines. Lower highs over here. The market breaks the support. Now we have a target. We go from the high here to here. We take that distance and we get a target here. And remember, target doesn't necessarily mean support. It's a minimum target. But if this pattern is valid, old support should become resistance. Swing target. And with the swing target, the market moves up or down. And you take the distance of the rally, in this case the rally, the market will correct. And then once it starts moving up again, you have a potential target. You take this height here, and you get added to the correction low, and you get a potential target. So let me show you an example of that. So, and we're going to be looking at bull and bear flags in a minute. This is very similar to that. Here we have the rally. The market digested the gains. And then once it breaks out, you take the distance. And I am a little bit more conservative. And traditional, for those who are familiar with the strategy or this measuring tactic, in most technical analysis resources, they'll take the target here and add it to the top. Okay, I'm a little bit more conservative. I add it to the bottom. So I'd rather be out early. So I would have a target around there. And, okay, market is stalling at that target. Same thing here. Okay, and this is actually very similar to a bull flag, which we're going to look at now. Okay, now I say here for a bull flag pattern, take the height of the move before the consolidation and add that to the breakout area. While this looks like a bull flag, the actual definition of a bull flag is a little different because the bull flag actually should have a slanting correction. So in other words, the market moves up. In the prior slides I showed you, the market traded sideways in a box range and then broke out. A bull flag, the market moves up, then moves down. And then when it breaks above the resistance area here is when you get confirmation of the bull flag. And so you take the height, the flagpole it's called, and you take it, once again, I'm more conservative. I add it to the low of the correction. Some traders will add it to the breakout point. Now, what candle pattern does this look like? Remember one of the continuation signals we saw yesterday before the window? We didn't spend much time on it, but the market moves up, and then we have a series of small real bodies, black or white, and then a breakout. It's a rising and falling three methods. We didn't spend much time on that yesterday, but it's a similar concept. In both scenarios, the flag is going to be a longer-term pattern, obviously, but in both scenarios, it's a way of the market relieving an overbought or oversold condition. The Japanese with the rising three methods, we have a white candle, then a series of 3, 4, 5 black real bodies or white real bodies, market moves up. Is a shorter term. Remember, the Japanese place a lot more emphasis on the individual candle lines. This, with the Western technical, is more of a broader perspective with the longer term action as far as construction of the patterns. So the rising and falling three methods, the rising three methods is very similar to the bull flag on a short-term basis. A falling three methods, long black real bodies, a series of small real bodies, and another black body that closes under the first black real body is similar to a bear flag. Okay, so this is a traditional bull flag. Market ascends, gets overheated, it corrects either with a down channel, or if it looks like a triangle, it's actually called a pennant. And that's your target over here. And right near the target, we got a bearish engulfing pattern. Once again, I wouldn't sell short on that. I'd definitely take off longs. So here we have, again, a bear flag. And that's my measurement. Another bear flag. And this is actually a bear pennant. A bear flag or bull flag is when the lines are upward sloping and parallel. A pennant is when it looks like it's a triangle instead of a channel. Same concept. Okay, now we're going to put together for east and west. And I'll show you some interesting things about calling highs in the markets and lows in the major indexes. So here we had, this is the NASDAQ in March of 2000. Remember what a typewriter was? Remember the NASDAQ at 5,000? But just to show you a combination of a group of signals we have joined together to call a reversal. Once again, no way of predicting the extent that the market had, the sell-off the market had after this. Okay, so see that dotted line there? That was a rising resistance line. Remember when we talked about resistance lines? And normally a falling resistance line, but I used this during the heyday of the bull market because there was no other way of getting resistance. So we had a rising resistance line, and right at the rising resistance line is a shooting star. Okay, it's still bullish because it's making higher highs, okay, but it's a shooting star. That's 1. Okay, 2. And anybody see anything at 3? It's small. Right. So we have a small falling window, which became resistance. And, okay, this is a moving average oscillator. Okay, it's 2 moving averages. The market was making new highs. What was the oscillator doing? Not making new highs. Now, I mentioned before, it's not enough of a reason to do a trade. I said during the entire rally, pretty much, we had this. Prices were making new highs, but the oscillator was not confirming it. But this is one of many clues. Okay? So I wasn't relying just on this. Okay, and then, actually at 5, there was a couple of things. A failure at the window, and what kind of candle line is that? Long upper and lower shadow? High wave candle. So we had a rising resistance line, we had a shooting star, a bearish engulfing pattern, a falling window, bearish divergence line, high wave candle. And I'll show you something really interesting. The high on candle line 2 on the shooting star intraday, okay, on an intraday was this. Bearish engulfing pattern. So we had, once again, from an hourly perspective, a bearish engulfing pattern, but it was this group of signals all together that really said the market was in trouble. I was looking for support down here, these long lower shadows over here. And then when the market broke under that, I started to get measured targets. Actually, what happened was the market broke out of a trading range. This was a big trading range. When it broke down, I just took levels lower and lower and lower and lower. And and lower. Yeah. I was doing I used to go to some of the NYC specialists. I used to go to when I started my company. I used to go to some of their shops and do advisory services for them. I used to go into New York and spend time with them in the morning. So this was when I was using an old, projector or whatever they had there. So I had transparency with me. So they, one of them, the projector was lower. So they said, "Can you make it higher?" And I said, "Is this good enough?" So it's funny because it reminds me also one of the I did a seminar after the markets closed at, again, another specialist firm, and they had beer there. I've never seen that. It was after the day and they had beer. And I said, "Good, the more you drink, the funnier I am." So, so anyway, it was a group of signals all emerging at the same area. Okay, this was an interview I did for technical analysis of stocks and commodities. This was back in 2003, and the timing was very, very fortunate as far as the question they asked me and I was able to respond. It was a whole interview about me and candles and so forth. And this was actually, I think, in the March issue. And this is an actual, you can check this. This is the actual quote I said at the end. After the interview, they said, "What do you think of the S&P here?" And I said, and this was the quote, "The head and shoulders top on the S&P gives a target to near," and actually I said near a bullish engulfing pattern near 775, to near 775. A close over 870 would void this. Okay, you can check the magazine on this. That was the interview session, and the reason I said it was such great timing, look where the market closed. Wow is right. So now I shift, and this is why it's putting together East and West. This is a great way of bringing it all together. Head and shoulders top, okay? That gave a target to actually around 787. The reason I nudged it a little bit at 775, I don't show it here, but this is in 2002. This is 2003 here. But back here, there were a series of bullish engulfing patterns on the daily chart around 775. That's where I got that. It was actually, the target was actually 787. I nudged it a little bit. So we had a target around 775 on that day, on the interview day, okay, on January 24th. And the target was based exclusively on Western technicals. Whenever I give a trading idea, there's always a price that says we're wrong. Why did I pick 870 to say my outlook would be wrong? The neckline. And the high here on the bounce back was 869. Okay? All right. Anyway, the market broke down. Now, it's unfortunate because the magazine wasn't published until March. It didn't do much good. But the market stalled right at the resistance line, and look what we got right near 775. And these, folks, were the major lows in the S&P in 2003. We had a target based on the head and shoulders confirmed by a candle signal. Now, I said before, normally if you have a candle signal confirming a target, we wouldn't think about initiating a new trade. But this was nice because we also had bullish engulfing patterns back here at actually 775. The low on the head and shoulders neckline, the target was actually 782 or 783. We got to 785. But the point is, this hammer was confirmation of the neckline's target, and just as importantly as the bullish engulfing patterns there. So East and West. Now, this was from January 24th, 2003. I used to do interviews at Bloomberg. They used to send a limo for me in New Jersey and bring me into New York. And I did that for a few, but I stopped years ago because it really wasn't worth my time. It was like a 3-minute interview, but it kills a half a day because it takes an hour and a half to get there. You sit there, makeup, and me, a lot of makeup. I tell them, try to make me look like Tom Cruise. They said, we don't have enough time. And then do the interview, and boom, it's back to my office. So I don't do it anymore, but when I used to do it here. So this was an interview I did on July 28th, 2003. And at that time, this is where the market was, I said major support near 960. My upside target is 1160. Okay? And let me show you exactly why I got this. Once again, it's Western Technicals, and with this one, it's using candles correctly. Okay. These were the lows, by the way, I had predicted back in January with that interview, which is over. This is a weekly chart, by the way. On the daily chart over here in January, we had the Head and Shoulders. Okay. My target was down here at 775. Interestingly, on the daily chart, we had bullish engulfing patterns at these lows here. On this weekly chart, look what we had. Right around 775, a hammer, a bullish engulfing pattern. So during this time period here, and during this time period here on the daily charts, we actually had bullish engulfing patterns. On the weekly charts, we had hammer, bullish engulfing pattern here. So anyway, these were my lows predicted back here on the daily chart in the prior slide. And we're over here now, okay? So we have a group of negative candlestick signals, a shooting star, a doji. Actually, can you see this black wrapping around the white? Yep. Bearish engulfing pattern. Yet, my upside target, now at this time, the market was trading at 996. I had a target 200 points higher. How come I wasn't bearish? Change of polarity. Look at that box range. Look how big. Remember, this is a weekly chart. Think of that coiled spring. The market is now above the top end of the box range. So yes, we had bearish candlestick signals, but candles in context, which is what we're going to focus on in the trade management section next, is although we had some bearish signals, I was not bearish until the market closed under 960. That was actually the bottom end of that old resistance becoming support. It had to close under here. And how do you think I got a target of 1160? That's right. Look what happened. Take the height of the box range, you get a target of 1160. Now, you don't have timing. You know, people ask me, how fast? You know, I might have a target of 1160 based on Western Technicals. When are we going to get there? I have no idea. It could be, especially in a market like this, it could be 2 days. It could be, you know, you blink your eye, it's done, right? Or it could be months. I don't do anything with timing. And we got there. So we're at the 1160 area. Okay, this was, so my interview was on this session here on July 28th. And next time I was on Bloomberg was on January 24th as the market was approaching the target. So we're going to go to January 24th. At that time, the S&P was 1154. Remember, back months ago, my target was 1160 when the S&P was 996. And we're here. And okay, so the market was around 1154 in the prior day. This was the interview day. And I say I'm looking for major resistance at 1150 to 1175. Okay, and I'm not going to go into why, but there were some candle signals previously. So the market gets there, and a few months later, and look what we get at 1160. Resistance area, falling off the roof, bearish engulfing pattern. Now, potential support here, right? The market breaks into support. How do you get a next downside target? You take the height of the range. Now, be careful, because it doesn't mean, just because your target, whatever this is, I'm going to make it to down here, it doesn't mean there's no support here, right? This is still a target. So if you happen to go short, there's no reason why you shouldn't take some profits at a potential support area, especially if you're getting candle confirmation at that support. But the point is, I had a target, and the candles confirmed that with a high wave candle. They're falling off the roof. Everybody see the falling off the roof? And the bearish engulfing pattern. So this is really a nice way of bringing it together. Again, these are all interviews I've done, and it shows the way that I personally incorporate Western Technicals with candles. You have your own favorite Western charting techniques that you're going to find that works particularly well. Stay with it. So let's go over what we've learned now. In this section, we've discussed Western Technicals, the importance of merging East and West. Okay, the synergy is really so powerful. Candles and trend lines. If you have a candlestick signal at a supported resistance area, especially if that candlestick signal is showing the trend is stalling, then we could be more aggressive on the trade. Volume in candles, Bollinger Bands. The Bollinger Bands are ways to gauge overbought, oversold, as are oscillators. Plus, with oscillators, beside that, you could use divergence. Record session highs and lows. Okay, candles and retracements, and the disparity index. So these are all examples, and price patterns. So we saw how we brought it all together in those interviews, whether the interviews of me were through magazines or on TV. So what we're going to do now is make our little guy go a little closer over here. Oh, okay. And now we're going to segue into trade